Morning, everybody. Hope you guys are doing well today on this beautiful Tuesday in Tennessee. And I don't know what we're doing in Indianapolis. Matt, how we looking in Indy this morning?
It is supposed to be 60 degrees today, so I don't have a hat on to
Wow.
keep my head warm like I do sometimes. So
Oh, yeah.
I can't complain.
Okay. Mr. Dan, how you doing?
Doing good. Everything. It's a beautiful day.
Yeah. Speaking of beautiful day, it's not a beautiful day if you were long anything going into the close yesterday. So for those who don't know, this is the OO show. It's day 2. We learn as we go, but it's a show where we talk about markets and things like that. And we are certainly have a lot to talk about this morning. So let's get into what we call affectionately the 0 DTE rundown. And there's only one thing on the agenda today. The market is crazy.
Oof.
So yesterday, I think we kind of set in a range for a little bit. You know, we opened up what, Dan, 30?
Yeah, about that. Yeah.
And kind of settled back into like where we closed Friday. And then some headlines came out about tariffs. And they said basically they're real. They're not fake. They're actually real things that are happening today. And then the market didn't like that. And then going into the close, another headline came out and said, hey, not just Canada and not just Mexico. We're talking about China as well. And then the market said, well, geez, Louise. And so we kind of we closed off the lows a little bit, but not much. And then today, what are we at right now?
Down about 40 in futures.
Yeah.
Okay.
Yeah.
Down about 40. So
Troy, are you saying that tweets can be real? I didn't know that. I never thought they could be real.
They say sticks and stones, can break your bones, but tweets can absolutely just wreck your account. That's how it goes.
That's right. Tweets can wreck your account.
Tweets can wreck your puts if you're short.
I mean, Dan, you were trading in 2018. I mean, what did it look like? What's the general thought as you look at this stuff when things go down? I mean, for those who don't know, I'll say it again. Dan was a market maker for a long time on the floor. He's seen it all. He's taught it all. On a day like today?
Well, I think the big thing is, I remember like 1987, to go back a few years, that was one of the crashes, or 2004. But I think the worst thing as a trader is it is panicky, right? So the only way to kind of alleviate some of that panic is have a good game plan, right? What are you thinking of doing, and the positions you have on, what do you need to do? Because if you go into something like this without a plan, we're all going to panic, right? So it's, you look at your trades, okay, what are you going to do? But even like today, you look at, you say, okay, what are we thinking? The E-minis are down, not too far off the lows of the day, but now, you look at some of these big numbers that have been in, we're down about 5.5% from the highs so far. But you look at some key numbers, Troy and Matt, if you look at the Jan 13 lows, they're within spitting distance, right? And that's what everybody's been looking at. And you got this, in previous months, you look at the 200-day moving average and you say, well, that's in New Zealand. That's far away. Now the 200-day moving average is a little more than spitting distance. But so you're looking at these things and saying, okay, we're down, we could be down 5, 6, 7%. And it's because of this terror. What's the game plan? And what's the game plan? What do you think makes sense? Okay, volatilities are up, but they're not panicking. VIX is still not panicking. And it's just, people trying to figure out this tariff thing. So, I think there's some opportunities in, some of these things, but maybe smaller size because, like Matt said, or Troy, at the end of the day yesterday, and you go down some more. But I mean, when you look at a high volatility environment, you can get quite a bit of room, like on vertical credit spreads or something. So it's like, okay, what's my game plan? What makes sense? What size? And in the old saying, what do they say in the military? Or if they don't say it, I heard it somewhere, so I'm going to give it to the military. In times of war, in times of peace, prepare for war. And peace is before the market opens, right? And you say, okay, here's what I'm thinking of doing. And if you, but here's the other thing. One last thing. If you look at retail traders, sometimes they think, well, they're giving money away. The market's going crazy. We've had 100-point, these are the biggest candles I've seen in a long time. Yesterday was 186 points. The average candle last week was about 92 points. So they think, well, they're giving away money. I should jump in. No, you shouldn't jump in. It's okay not to trade unless you have a clear idea. This is what I want to do. This is the capital at risk, that type of thing. So I think it's just, take it easy, put on some classical music as you trade today and just, relax, but have a game plan.
Mm-hmm.
Yeah, I think it
makes sense.
I think and I'm certainly not a macro economist or prognosticator really of any sort, but it is interesting with these tariffs because we were at, market highs, what, a week, 2 weeks, I don't know, within the last month, right? And the tariff talk was still very much happening then too. And I think this is an anecdote, but to me, it was a little bit of a weather check. There's a Honda plant here there's only one Honda plant in Indiana, and it's been here for decades. It used to be a customer of mine in a former life. They build Civics and some other stuff there. And they recently announced yesterday that because of tariffs, the next Civic will be built in Indiana. So I'm assuming it's at that plant, but a lot of the tariff commentary that I've seen has been how much of this is posturing and how much of this is like real escalatory, actual kind of trade conflict. And that news note yesterday was an interesting data point for me because that was a fairly concrete thing. And of course, that could be just, they could have already planned that and be using the tariffs as cover. Who knows? But I think there is this escalatory thing in the markets, at least the last 6 to 8 weeks, of the discussion kind of being ratcheted up about the tariffs. And the market does seem to be pricing it in a little bit more seriously. Obviously, these things have many second, third order effects for us. A higher VIX, like you said, Dan, a higher VIX is actually helpful for a lot of trade styles, depending on what you're doing. And it gives you breathing room, depending on what their strategy is. If you look at things that typically a large move might blow out because vol is so expanded right now, can give some of those strategies time to breathe, time to work, room to breathe, all that kind of stuff.
Hey, man, if I could just add one thing to that real quick. When you think about the COVID correction, right?
Yeah.
And people, I think they have a misconception that sell high volatility. I have no interest in selling high volatility until there's a little stability, because you can run out of money that way. Because in the COVID correction, you could sell volatility when it went from 20 to 30. And then you know what? You could sell it when it went from 30 to 40, 40 to 50, and 50 to 60, and 60 to 70. And then you run out of money way before that. So I think it's very important to, when you're going to sell volatility or sell puts or sell put credit spreads or something, or call credit spreads, make sure you think there's some type of, especially on the put side, that there's some type of stability. Or you think, okay, hey, this is where I draw my line in the sand. I think the market's going to stabilize around the Jan 13 lows. Okay, that's a plan. And if it goes against me, this. But just remember, vols can go higher. Right now we're very under control, I think, 24 and under. Once we start 26, 27, 30, then it's like, whoa, so just, I think, have a plan. Don't just idly, a lot of people say, well, the volatility is in the upper end of the percentile. I don't care if there's no stability, right? And you're going in and selling puts, it could be an unpleasant experience.
That's right.
Yeah, the funny thing to me is I get the sense very much that there's a little bit of confusion still about what a tariff is in general.
Yes.
You don't, like, what is a tariff? Is a tariff? It's a tax, but who's it a tax on at the end of the day? And I think that's really, in some ways, what the market's kind of digesting right now is that, there's someone's going to pay this. And I think there's a large number of people that say it's probably not that government that's being tariffed. Someone else is going to pay it. And so that's just part of the thing. I wanted to look real quick at a strategy, Dan, and talk about kind of the pluses and minuses of it. Because as you were saying, you have to be careful on the put side about this stuff. You kind of have to be careful about when you're doing it. And I want to look at a strategy that wins a lot and then gets crushed really, really bad, and some ways that you can maybe think about that discretionarily. So what I'm going to do, you guys see my screen okay?
Yes.
Yeah. Okay, cool. So this is the back tester, this option mega back test. And it is done from March 3rd of last year to March 3rd of this year. And this is a 25 delta put spread. I'm sorry, no, my fault. A 10 delta put spread that's 25 wide. So you sell the 10 delta 0 day, and you buy a put that's 25 points underneath that. So for those new to options, this is what you call a short put spread. Dan, are there any other names for this that you would, all the names?
Put credit spread,
Put credit spread.
Put credit spread.
Yeah,
I'm sure there's many more.
Yeah, selling Z puts is one way.
Selling Z put, yeah.
And so you open this at 9:32 and allocate 10% of your portfolio. Again, options involve risks, not suitable for all investors. I wouldn't allocate much of 10% of anything, So, but just for the test. And what's interesting to me about this, Dan, is because you're selling premium, because you sell puts, and because the contracts are constantly decaying, a 0 day put is decaying very, very fast, right?
Right.
And because of that, you're collecting money very fast, you're collecting theta, and you're going to win the majority of the time. Because remember, when you sell a put or a put spread or something like that, you don't have to have movement. It could sit there all day, and if it doesn't move, or if it doesn't move much, it's going to win. And again, that's why options are so cool, is that you can make money from neutrality, which is one of the rare things in the market. So you win 90% of the time, but notice that even though you win 90% of the time, you still are down huge after 1 year. And the reason you're down huge is because you have been putting a put spread on perhaps days you shouldn't have. Now, if you knew what days to put the put spread on, we'd all be zillionaires, and we would be, on our island, not our private island, not that kind of private island, but a different kind of private, a good private island.
That's right. You want to be careful with private islands.
That's right. Yeah. Watch out. We're neutral on private islands.
That's right.
But anyway, but what happens? So let's look at the trade log, some of the losers. Well, guess when the last loser was? It was yesterday, right? And so what happened? Well, this is the nice thing about this. You can kind of see. You opened it at 9:32 when we were at 59.78, right? Because you sold the 10 delta, you sold a put that's 78 points away. Now, the vast majority of time,
plenty of room.
The vast majority of time, 78 points away in a day is going to win you some money, right? It's going to happen. You collected $1.35 on this trade. You had to, when this trade expired for $25.
Houston, we got a problem.
That's right. You have a 1,700% loss on this trade.
Wow.
So it only takes a couple of those absolutely wreck this type of trade. And so you can see here real quick, this is a replay of what happened. You put the trade on, everything's sitting nice till about 1 p.m., about 12:55. Remember, look at the timestamp of when some of these tweets come out. And suddenly your price is going against you. And remember, if you're new to options, price goes up. I thought that was good. Well, not if you're short premium. Right? You want the price to decay. You want it to go down. And you can see the VIX as the VIX rose. That's not helping you at all. Right? Even on a 0 day, you're kind of, the VIX is not helping you. Now, not to a great degree, but it's not helping. And then the underlying just continue to go down. So this trade, you know, someone comes to you and they say, I got this trade that wins 90% of the time. And let's say they got a bad data set where they didn't get to some of the losers. And they say, this thing just is a cash cow. It's a printer. As you look at that type of strategy, what would you kind of say are the first red flags with something like this?
Well, the first red flags, anytime somebody comes to you and says, I have a high probability trade, and they start talking, I'm in the 90s percentile. Well, you just know, as in life, as an option, you can't have your cake and eat it too. So if you're talking anything in the 90 high probability, which is great, the risk management is horrible, right?
Yeah.
So that means, yes, you're going to win 11 times out of 12. And then if you have no risk management, you get cleaned up, right? So probabilities, you know, just like a great risk reward doesn't make a great trade, a great probability doesn't make a great trade. Your risk management makes the trade. Okay, if I win 90% of the time and I'm making $1 each time I do it, that's great. But you can't be losing much more than, let's say, $3 if it goes against you. You have to have some, as you guys say, guardrails, right? And I think risk management is really, you know, the name of the game with options trade, especially when you get into the high probability. I'm going to sell a 5 delta put. I'm going to sell a 10 delta put. There's nothing wrong with that, right? But you better have a solid risk management plan. That's like saying, I'm going to go at, you know, every morning, you know, every evening at 4 a.m. to the west side of Chicago, the Englewood neighborhood where there's a lot of killings, and say, you know, someone's giving away $100 bills at 3 a.m. Well, you better have some good security with you or something to help you actually get out of there with your money. And so I think a lot of people, I think there's people who make a living trading, selling 5 delta puts, or, you know, think of the world of cash secured put, right? It sounds nice, right? But I sell puts in Apple or Microsoft or Nvidia, and I'll buy the stock if it goes lower. But I think, you know, you have to have some type of plan. At least when people sell cash secured puts, there's a plan, right? It's saying, hey, I'm willing, if I sell this put, I'm willing to buy the stock lower if I get assigned on the put, right? I mean, you could, you know, you have different ideas on that. But anyways, I think the people sometimes jump into these probability strategies without really thinking it through. You know.
Can I have a thought on this too, if I can jump in. If you pull that back up, and this, we should probably do a whole show on this, but this actually illustrates a really interesting kind of higher level concept. What Dan was just talking about, risk management, this is a good illustration of sequence of return risk. If you look at the last week, how many losers have you had? You know, just the last, there you go. So you've had 3 losers, max losers, since February 21st. So I personally, in my evolution, I still do some credit selling. I do less credit selling. And one of the reasons is sequence of return risk. When you have something that has a low loss rate, a high win rate, but the losers are big, what I prefer to do is kind of take the other side and find debit trades that have very low win rates, but when they win, they have much bigger winners. And that way, like, I have a debit strategy that won 4 times in a row, like last August, September. I've put it on religiously every week. 1 winner since then. Like, I'm down significantly. Well, not significantly. I'm not down significantly. It's been a very gradual, slow decline. I put it on every week when it qualifies, assuming it's going to lose. And I'm not exposed to sequence of return risk from that, because it's it's probably going to lose. It has a 10% win rate, roughly, you know. Something like this, if you catch the RNG, the time period, the noise, when you have a 2-week period, when you have 3 losers, if you started trading this at the beginning of February and you had a string of winners, and then you had 3 losers in 8 or 10 trades, that would make a dent in a portfolio. So we could do a whole show on kind of sequence of return risk, but this is a great illustration, Troy, of, you know, 2 of the last 3 times you've had a 90% win rate strategy just get absolutely doorknobbed and not good. You know, like you got hit in the face with it and just not something anybody would want to stay in. So that's a great example.
Well, in the reality, Troy, nobody will ever, you know, we're looking at this. So, Troy, if you could bring that up again, but when you look at that thing as a retail, you know, we're looking at that as someone's actually going to go through it. I mean, if you talk to the reality,
that's right.
If you talk to reality, is someone going to stick with it and do, you know, lose the last 3 trades? I don't think so. And
No.
I think, but the problem isn't the put credit spread. The problem isn't vertical spreads. The problem is somebody didn't have a good plan and a risk management on the plan. But unfortunately, when someone has a big loss on a trade, they're done with it. They'll never say the word in public. They'll never talk about puts or anything like that. And I think but the other thing is when I think it's a recognition of, you know, if you say, Dan, you went out in shorts. Are you okay? It's 32 degrees. There has to be awareness in the market. What is speed? And I think if people look at like an expected move and say, okay, the expected move is 30 and we've moved 80 points for the day, something should go off in the, you know, in the mind that, hey, this is a much more volatile day. If I'm going to do a put credit spread, am I going to do smaller size? Am I going to hedge it with a put or get more downside protection? I think recognizing the environment we're in is important. And but anyways, yeah,
for sure. Well, I wanted to show 2 quick things, just ways to improve this test, and both of them involve trading a lot less. So the main thing I want to show you before you go to 200, you know, this has 250 trades in the last year. A put selling strategy, you know, a put selling strategy is the closest thing in my mind to a card game. And you want, because it's a numbers game, and you want to increase your odds any chance you can. And so I'm going to look at 2 ways to increase my odds here. And the first is, what happens if I only in the last year traded when the market gapped down 1%? So we opened down 1%. We put this on, same exact trade. And I want you to notice, the data set, 250, 6 trades, you know, you're trading a lot less. But you could go back farther in time. I mean, you could back test this all day if you wanted to. You know, I'm not doing that. So I wanted to show you the idea of just being more discretionary, stacking the odds. Because what are you doing? What are you doing when you put a spread on at 932 when the market's down 1%?
Yeah.
Well, the market's down 1% already.
Yeah.
That's how you have to look at it. Now, that's not to say the market can't go down 5% more like during COVID, right? So I would definitely test this during COVID. But it's about putting parameters on this thing. You could also do stuff where it's like, well, COVID would have wrecked you. Well, maybe you don't open this if the VIX is over 30, right? Yeah. Maybe there's some things you put on in that case. So that's the first one. The second one has a little bit more trades, but not many more. You, over the last year, if you said, I'm going to put this on anytime between 9:32 and 1 p.m. when the market has moved down 1%, right? I'm going to do that anytime we do that. And what you'll notice about this is you have a huge win rate again, but because you're trading less, you're picking your spots more. You just have an edge that you don't have if you're blindly putting it on in any VIX environment, and any type of movement and things like that. And so what I wanted to say with this is basically you can have the same type of strategy, just what Dan said. It doesn't really matter about the vertical. It doesn't really matter about the specifics. You know, anytime someone says it has to be 22 and a half deltas or it doesn't work, like that's a carnival. That's a trick shot. You know, it's not, but this is basically about taking ideas and saying, applying the risk to make it work. And those are two just quick ones you can do when you're selling put spreads to say, A, have we gapped down a lot overnight? Okay, this might be an opportunity, right? To put something on. Again, presuming that we're not, to Dan's point, like in an uptrend of VIX, and there's some ways you could test that, you know. Or two, if we've had an intraday move down 1%, you know, and especially if it's been pretty early in the morning, I would add that. Like if we have a down move in the first 30 minutes and we kind of have 10 minutes of sitting there, you know, you take a shot.
Right.
You know, and you're not going to win them all. But you're going to increase your chances. And that's about what it's about. So you guys have any thoughts about those two?
Let's see. On the two, I think the main thing is that you approached a little more with a plan, right? Okay, instead of just throwing this, I'm going to sell puts, I'm going to do this 90%. Now you came you left planet Pluto and you came to Earth and said, okay, let's try this again. Let's go back to the drawing board. Let's do this on, okay, when the volatility's up or when we've gone down, even like from a contrarian point of view. But I think now and then the next step is, as people get into, okay, I have a high probability trade, you know, I can make this. How many years I've heard people say, you know, I got this trade on, this is what I can make, and here's what I'm looking to make, and I'm like, wait a second, let's change this conversation. What if it goes against you? What's your plan? Well, I'll see. I'll see is not risk management. I'll see what I'm going to do. I'll see how bad it gets. And I think, you know, there's nothing, you know, if you're doing, I have an example up here. Try, you ready?
Yeah, let's do it. Show me.
Should we?
Yeah.
So do you see my screen?
I do. Yeah.
All right. The one thing I did realize, if I annotate before, you don't see any annotation on it, do you?
No annotation.
No.
Sorry.
Oh, okay. But if you see, let me see if I annotate now. So this is where we closed last night. Oh, it's not showing. Okay. But we can just, if we closed last night at 58.50, I'll just use that for a second. Here I have an example of, this is just basically a March 28 put, 28 put credit spread like Troy was doing. And here we go. We sell it for $1.50 and we're selling the 55.50 strike. So right here is around where we closed last night, 58.50. And because the volatility is up, what does that mean for put credit spreads? It means that normally I'm not going to get 300 points out 24, 25 days, but now I can sell a 55.50 put. And I can buy a put underneath it at 55.40, 10 points away. So I have $1,000 of risk on this put credit spread, and I'm bringing in a credit of $1.50. So my risk, if the world ends, is $850. So the question is, if I'm looking to make $150, right? And I'm going to make $150, like Troy said, 85 to 90% of the time. I like that part. But how much, just from a risk management, how much can I let this thing go against me to screw up this game, right? If I'm winning 90% of the time, I'm getting this $1.50 credit. I mean, so basic risk management would be say, look, if I'm looking to make $1.50, if this goes against me, you know, if the $1.50 goes to $3, I lose the same as I brought in. If the $1.50 goes not just to $3, but to $4.50, I've lost twice what I make. And so risk management is saying, hey, I get it. I can make my $1.50, but if this thing goes to $4.50, meaning I sold this credit spread at $1.50, I got to buy it back at $4.50. I lose twice my credit. Okay, now you're getting in some sanity. You're saying,
Yeah.
okay, I want to make my 150, but if I lose twice what I bring in, okay, then that knocks out 2 trades. I can live with that. Right now, you're starting to get sanity, and then as you develop this, you can get into, okay, like you said, and what Options Omega does is, okay, do I want to do this when the SMA or some type of moving average is at a certain level, when the VIX is here, and then you start playing around with it on backtest, and you go, hey, this is something that makes good sense, right? And but I think there's always that, but I think, that's where you get into that's where it goes from a crapshoot, which options should not be. Options were invented for risk management, and that's where I think the back testing is wonderful, because you can see, okay, now I left Pluto, and I have this, I have some risk management, I have some guardrails, I've got VIX, I've got now it's something that makes sense, and you can move forward. So anyways, and I think today, it's interesting. We're going to open down, right? Not that far from like the big Jan 13 lows. And I think, someone might say, hey, would you sell a put credit spread on a day like today? Well, here's the other thing. Size is a tool, right? You don't have to sell 10, right?
That's right.
You could sell
That's
one.
right.
You don't have to sell 10. You could sell one put credit spread. Okay, if it goes against me, this, but and that's kind of you could call it contrarian, right? Because the masses are usually wrong. I mean, I remember this in the pit. Market makers used to do this. They'd walk around to the different pits in Chicago, and they say, what do you guys feel about the market? Oh yeah, we're pretty bullish. They go to the next pit. What are you guys? Pretty bullish. After about 3 pretty bullish, they'd run over to the OEX pit, which was the precursor of the SPX, and they would buy puts, right?
Yeah.
Because they're just saying, there's no way this many loonies, there's this many guys, if they're all bullish, we're going down. If they're all bearish,
That's
we're
right.
going up. So, I mean, you want to be careful. I think what I've learned, and I've learned this in the retail realm, when we left in the market maker realm in Chicago, we're more volatility traders, risk management, where it's key. And in the retail sector, I think people put an exorbitant amount of energy into technicals and stuff. But what I've learned is to appreciate it, that if you can combine technicals with the risk management, I think that's a powerful tool. And that's where, and that's what I've gotten from working with retail traders, that there is some good things with technical analysis. As long as you combine it with risk management, and risk management runs the show.
Yeah, no, that makes complete sense. I'll just show you one more real quick before we go, if it's all right. Just while you were talking, it gave me 2 ideas with this. So basically, if I added 2 things to this same, this is the one that loses all the time. This is the one that you were down 40K on. So add a stop loss, the 300%, right? And this is the first step. Just add a stop loss. 2, only put it on if the VIX is up at all. Like if the VIX just kind of 0.01%, it doesn't have to be crazy. Just any VIX move up overnight, we're going to put it on. Well, it's a winning trade then. And to your point, Dan, just sprinkling the parameters of risk management can make a trade that really can be good, that's been in the doghouse, work for you.
Yeah. Hey, Troy, can you explain that for everybody, that stop loss of 300%? Maybe
Matt's the master of explaining this.
All right.
Sure, and I'll try to do this quickly, because I know we're people are going to start trading here in a little bit. But basically, the back tester is using 1-minute data in this test. We actually have an intra-minute option as well. We're just showing a quick concept on a live video here. So it's checking once per minute. And once you get to a 300% stop loss, so basically 4x of what the value is, the back tester will stop it out. And what's interesting is because it's 1-minute data in this back test, it can sometimes be greater than 300%. So it would just be getting you out at the mid of that 1 minute. Like I said, there's higher resolution stuff we could do, but just as a concept, adding the VIX and adding a stop loss completely changes the trajectory of the trade. We'll still keep in, 80% win rate and whatnot.
Yeah. And people do it different ways. The way we calculate it is a multiple of the premium received. or
That's
the
right.
multiple of the debit paid, right? If it's a debit strategy. So anyway, I know we're running up against it. Final thoughts for today. I wish you guys the best of it
Yes.
as we're trading.
Yeah.
Dan, I'm sure you're going to be answering phone calls throughout the day of people who are scared in these markets and things like that.
Yeah. Have a plan. Have some, as of yesterday, have some good Bob Dylan music on as you're trading. That will sedate you a little bit.
Yes.
Not that you can understand what he's saying, but
Yeah.
you know.
That's right.
Yeah. No, this is on days like today. It's a good to remember Bob Dylan line. Someone's got it in for me. They're planting stories in the press. That's a beautiful day for Tariff talk. So, all right, guys, listen, have a great